first question that we ask is not कि ये return कितना देगा. The first question we want to answer is कि इसमें risk क्या है. And that is how we planned this. If you've been following us across the year, we've told you different risk parameters that we put in place, and all of that protect the downside. Are for us, if you want to make money in the market, the very simple rule is that you live tomorrow. If your account gets blown today, there is no chance you're going to make money tomorrow. If you can survive today in a downturn market, then tomorrow you can have the chance of making money back. So that's where we kind of do. Let me just start sharing my screen, So when we were thinking about this session, we probably were thinking about risk from almost the last 15 days. We've always thought about it, even in January when gold and silver were kind of running very high. We said that this is kind of a mania. Similarly, when we looked at the Korean market, we said this is a mania. So when we were discussing as to what we should do, the team was on an early morning call, and we were discussing as to how do we bring this out to people, and what should we call this session eventually. We asked around, and two people almost replied verbatim, we should call it something related to risk. It is risk as a parameter itself. We've not ingrown. Had this been written, we would have had something very fancy to write. But risk as the parameter itself, people do not think in the first principle terms. So it came out as, we should do it something related to risk. And that is why we named it something related to risk, because that's the best name that you can kind of give a parameter which eventually does not give you, does not keep you returns. It does not give you that adrenaline rush. And what we eventually did was that in January, in our annual outlook, we had 9 risks out there. So in our January outlook, we had almost around 5 risks. We added another 4 in April. So we went into this whole year with total of 9 risks. We added 4 more because obviously the conflict took place in March, and we added the risk attached to it. So what we are now going to do is we're going to take each of those risks, see where we are, and basically mark it against ourselves and see that whether those risks today apply itself, and what is the updation that we need to do. Before we move into the session, again, standard disclaimer: markets are subject to investments in securities markets are subject to market risk. Any performance that we show here is basically past performance. Every cycle is different. Every client for us is different, and every risk profile is different. Do not look at past performance and extend it to have happen in the future as well. So last in July, we said we were here. This is a map in July. We said that we are very close to the supply, and the supply isn't stopping. At that point of time, we'd added a new supply zone, also saying that there would be a new supply zone that is appearing between 24,600 to 25,000. And we were basically between this. Almost looks very similar. Don't get confused. This is end of what is it? End of June, I think. Start of July, not start of August. Even if the numbers look very same, it is like that. So this is how it kind of moved. So we said that we are in an indecision zone. There's a weak demand zone there. There's a supply zone right on top, and there's a strong demand zone right here. So the market kind of moved in this direction across the last month, trying to figure out where to go. So at a demand place, it's kind of demand is stepping in. At a supply stage, supply is stepping in. Both are kind of not giving in. So it's a very choppy kind of a market. What we've kind of done is in this time, as at supply, any weak conviction that we had, we took those out. At the demand, any strong conviction that we had on particular stocks, we added in there back. At this point of time, we believe that again this kind of choppiness continues for a bit of time, and hence we've positioned ourselves in that manner. We'll take a look as to how that is done. Why this session exists? Long time ago, I think almost 900 years back, people thought that risk or anything that happens is basically fate of God. While most of it is true, there are certain parameters that we can use to find out the probability of a particular event happening. What before kind of we thought about numbers, the entire future belonged to kind of to gods. You prayed and then you accepted whatever came around. In 1654, Pascal and Fermat basically prized an unfinished game. They were playing a game and then they could prize how certain moves could kind of end the game, and with that, a certain probability was actually born. What Bernoulli did was that he used the law of large numbers, and then kind of with these large numbers, you could kind of you could basically find the probability. What Bayes did, that if certain events had happened, if you remember, if you go back to your class 6, 7, 8, 9, 10, I think somewhere down the line, you were taught something called Bayes theorem. Bayes theorem is that if certain event has happened, what is the probability that the next event can take place? So Bayes taught us updating probabilities. Eventually, if you are a science student or you are a statistics student, you would have heard about Gaussian distribution. So Gauss gave the error basically. So whatever error came across, it got a shape, and eventually, there was always a mean reversion that was kind of brought into the picture. The entire word risk comes from an old Italian word called risicare, which is basically to dare. So basically, risk is not something that happens to you. Risk is something that you accept, you choose going forward. So when you're taking a decision, even on a stock, it is a decision that you're taking. Then saying that this happened is basically something that you should have probably figured before taking a trade. So something if you've taken Korean markets at probably their 120% high and gone in with 35% leverage, then you are actually not situationally aware, right? So if you blow up, it's something that you've not managed well. So again, what we did was that in our annual outlook, again, this is a public document, you can go back, check. We said we dropped in 5 risks. We updated those 5 risks with new risk in April. We added another 4. You can see 5 here because inflation second wave was basically a repeat of the previous risk, and inflation second wave. While the probability at the beginning of the year, the probability was very low. In April, we upped the probability to a very high probability post the conflict. We thought that oil is something that could create a lot of trouble across the world, and the risk of inflation coming in again would go up significantly higher. It has become so evident for us that our whole register now, our whole thesis itself has now become a portfolio that is built for inflationary world. We think we are moving to a very inflationary world. The regime that we are tracking now is basically where yields go up, real assets go up, and you should not be in bonds as well, because your inflation will kind of eat up your fixed returns that you kind of move towards. So this is the total risk parameter that we kind of did. So these are all the 9 risks that we've done, and we've written it down for you to, again, this is public information. The probability that we set it at, and the impact that it will bring on the market. While you can do the probability and the impact, the major reason or the major thing that people miss out on is the second part, which is where we also kind of give what are we tracking? How do we know that this risk has kind of triggered for us, and if it triggers, then what we are going to do? So basically, on a particular day, any morning, if the market's cracking, we don't panic in that regard. It's already written. This is a very simple exercise that everyone can do. Every investor out there should be doing that. If you know a risk, what is the probability, what is the impact that it can have in the market, but have a warning signal for you that if this happens, then this risk has got triggered. Not that a market movement of around 10% should define your risk. It is the particular thing away from the market, away from those price movements, that should basically define the risk. And once that has happened, what am I going to do? If all of this is kind of written down, and if all of this is the rule, then on a day which where market, let's say Korean markets are down around 10% or odd, or they are up 17%, or a particular stock is down around 15 to 20%, you don't panic around it. You know that this is what I had this. If this fundamental thing has not triggered, then I should not panic over it. What is changing beneath the surface, and then you act accordingly. So this is the board kind of written. Now at this stage, what we'll do is basically we'll remark it up as per what is going on in the market. So basically, again, this is like finishing up an unfinished game. You're assigning probabilities to a moving game, and at the halfway point, we're kind of remarking this again. So till now, one risk for us has promoted out. So this is the risk of the second inflation wave. The second inflation wave is no more a kind of a risk for us. It is our whole regime. So something that you have built your portfolio out for cannot remain a risk. It becomes kind of your base case. So what we've done is we've taken the risk, we've built our portfolio around it, and that has promoted to our thesis itself. So we're retiring that row. One other risk has particularly fired for us, and then there are 3 which have partially fired and 4 which haven't fired till now. So this is how we've kind of this is how we are going forward. Even in the definition terms, we kind of moved ahead in terms of definition, because obviously markets have moved, fundamentals have moved. So this is the kind of the risk dashboard that we are managing at this stage. So as I was saying that, we've promoted out the inflation second wave. So what this has given us is basically, at this stage, we believe that disinflation trade is over. So what has gotten us here, starting from 2020, forget 2020, starting from 2008 itself, we've not seen inflation as a being in the headlines ever. So this is almost a 18-odd-year trade, which we think should not stand anymore. It is a regime change that we've kind of, if you've been following us, then from April itself, we thought we call this regime change. And we think that this is our base case. This is what we're building portfolios for. We're building portfolios for an inflationary world where kind of, how to protect yourself when inflation goes up and your real returns kind of start coming in. For that, we've set a particular tripwire. The tripwire basically tells us that if CPI stays greater than 5% for 2 months, if oil stays greater than $100, and if food inflation kind of returns, then we promote it out. While CPI, you may argue CPI at this stage is 4.38. It has the food inflation has started coming in. It is around at 5.3%. This is for the first time since December 2024 that inflation has breached RBI's target, the band of the 4% band between the 2 and the 6%, the average 4% that RBI targets. This is probably the first time that CPI has broken that out. RBI now itself says that we see inflation at 5.1%. So when the central bank is itself accepting that inflation should be higher than where we are right now. So that is the regime that we kind of have built the portfolios for. The second one which has gotten fired is basically a low intensity, long conflict. When the conflict happened, we stated 2 states that can happen. One is basically either the conflict remains low intensity and stays on for a long period of time, or oil kind of goes above $115 on an extended basis. So these are the 2 stages that the conflict could have taken, and the certain tripwires that we set for it and where we kind of stand for it now. So when the tripwire that we set for it was that Brent should come between $80 to $90 if the conflict extended for a long period of time. We are there now. So we came down to $70, almost 71 odd dollars. Now we are back to 80 to 90 range, and this is the range that we kind of think that oil settles into before moving forward, and how that extends into our risk parameters will show in the upcoming slides. The valuation compression that we thought India should have. So at the beginning of the year, India was at around 24 times earnings, and we thought that value should compress. That kind of has happened itself. Now the valuation in India is around 20 times. However, the reasons that for which this should have happened was we thought that FII outflow should be $3 billion, greater than $3 billion per month, which actually has happened out in the first half of the year. Like in the first half, $30 billion has gotten out of the country. So that has triggered our kind of partially fired our valuation compression. Nifty P did not stay above 24x for a long period of time, or so that is one parameter, and hence we call it partially fired and hasn't taken hasn't happened to the T for us. However, valuation has compressed, and that is why you see us go overweight on equities as well over time. Earnings cut deepen. Again, this is something that we added in April when analysts across the board kind of said that we're cutting earnings output. At that point of time also, if you remember, we said that always that analysts are generally wrong. However, we want to take that, we want to kind of have it as a risk. If something like that happens, then our overweight position on equities kind of start not making sense. So once that happens, what we wanted to figure out was basically if there were misses in financials and energy, and if the EPS was cut by, if the entire year 2027 the EPS was cut by greater than 15%. What has happened is basically analysts have continued to downgrade. RBI itself has cut the GDP forecast for this particular year. However, the results have been very interesting. The results have actually been the other way around. So companies which have reported the results, they have actually reported decent enough results. So for that reason, we're keeping it partially fired. The next risk that we have got is basically the China stimulus disappoints. This is something that we if you go back and look at this parameter, we said that it has a very high probability of having. Why? Because China generally disappoints in a stimulus. Whereas if something like a spring comes after winter, if that is the given, then China stimulus generally disappoints. That's a given. And this has happened across this particular cycle, this very young cycle that we've seen. China has not delivered on its stimulus kind of promises. We said that could probably happen, and that has happened over the year. Over the whole this year, we've not seen stimulus come into China. Rather, the loan growth there is pretty lower. However, when a particular market thinks that this is a very high probability, the impact that it can have is pretty low, or it shouldn't have a big impact on it because it is almost priced in as such. So once that is done, we kind of we still continue to have an overweight on China. Oil above $115 extended being the key word there. We've not seen that. We've seen oil above $115, but we've probably seen that for around 5-10 days, not much bigger than that. However, the major tripwire that we've set for that is that oil currently is something in a backwardation, and we wanted to move to contango. What does backwardation mean? So basically, if you look at the futures market for oil, generally, if I am holding a commodity, my future price should be higher than my current, like the next month price. So if there is a spot price that or if the first month kind of prices in the first month prices in your futures market, the second month price. So if right now your August month is your first month, then your September price should be higher than your August price. Why should it be higher? Because the commodity needs to be stored. So there is a storage value. To buy that commodity, you would probably take a loan. So there is a financing cost as well. So both these costs, storage cost and the financing cost, add on to your current spot price, and hence your future price should be higher than your spot price. So your second month future price should be higher than your first month spot price, and once you take the whole curve, your prices should be higher itself. What we are seeing in oil is that it is not so. So people expect that in future oil prices will be lower than what prices are right now. If this were to flip, if this were to become true that future prices become higher than what they are at the current level, then oil stays above $100, $110, then oil being more than $115 extended becomes a possibility. We're not seeing that right now, so hence that's not fired. Global recession we think is not something very in the near future, is not fired yet. Rupee breaches 100. We'll come to that. Very, very common question, very common risk right now. And the US labor market as well. We'll come to that. So what we're doing is that we're taking each of these and showing you what are we looking at and why we think where we are. The first one obviously is the promoted one. The second inflation wave has now become the thesis. And why has it become the thesis? Because we are seeing a world which is moving towards deglobalization. So over time, we saw a very globalized world. It made sense. Why did we have a globalized world? Because it made sense that you produce at a place where it is cheaper, and then you sell at a place where your margins will be higher. However, now in a fragmented world where allies are very different, you're moving away from globalization. A deglobalized world is generally a very expensive world. If you go back in time during the Cold War time between 1950 to 1990, you would understand that at that time also inflation was quite rampant. We've been here before. We think we're moving there again. Governments across the world are running fiscal deficits. The public debt is probably at its all-time high. A kind of a fragmented world brings in a lot of defense spending also, because you have different allies. You don't know who is your a friend or a foe right there, and then what that does is that you increase your defense budgets or your defense capabilities to protect against a particular enemy attack. What this leads to is basically a commodity super cycle, which we're starting out right now. So we're very young, we're very early stages of a commodity super cycle. So commodity prices keep going up, fueling the inflation curve. And then even also along the way, you have very tight labor, and an aging workforce is something that we've seen previously before as well, when inflation is pretty high. Uh, so when you actually look at inflation kind of moves again in different waves. These waves are quite extended waves. So the shortest wave that we've seen is between 1998 to 2008 and 2008 to 2009. So the up and down moves are basically over the last 100 years have ranged between 10 to 18 years. So 18 years here and 10 years here. So between 10 to 18 years, if you look at this new inflation cycle and think that if it started from 2020 itself, we're still in year 6 now. So we're still young in this particular cycle. This has years to run, and hence we made this our base case, and making portfolios or our portfolios basically now want to protect against inflation in a way. The one that has fired is basically the conflict risk, where we think that it will be a long extended conflict, low intensity but long conflict. What that has happened is basically oil kind of stays between the 80-90 band for a long period of time, increasing trouble around inflation. And the second portion is basically that if it then moves to if your backwardation moves to contango, then you have trouble brewing in. So that $115 slide is also coming through. The idea here is that the duration is very important when we actually look at when we want to see in terms of CPI pass through. So a higher oil should generally increase CPI, but higher oil above $100, the timing is a major thing. So when the last three instances when oil went above $100 in 2008, as well before the financial crisis, you had oil peak out at almost $146, but the amount of time that it spent above $100 was 7 months. During the Arab Spring, which happened between 2011 to 2014, the peak that was reached there was $127. The span that oil took above $100 was 3.5 years. And in 2022, when we had the Ukraine-Russia conflict, the peak at that point in time was also $128, and the span that oil stayed above $100 was 6 months. Right now, oil has stayed just 2 months above $100 before coming back before the ceasefire, and now trying to again both the parties want to solve it, but the stalemate is kind of unresolved. So the amount of time that oil spends above $100, that $115 tripwire for us kind of gets triggered. What that $115 tripwire does, if it gets triggered, it just fuels the inflation thesis. So you can slice and dice this anyway. One thing that we are pretty like the least unsure of in this particular regime is that inflation is gonna come back with a very high number. So if you can protect your portfolio around that, it will be much easier to manage your portfolios. The other thing that I think now what we're looking at is the partially fired ones. The China stimulus disappointing. Again, I said this is something very common in the market, at least but after 2020. Once they have seen a very high debt to GDP ratio, once they have had that property bubble collapse, we've seen that China has never followed through on a stimulus announcement. So there, what we had the tripwire that we had said was that credit growth would be less than 8%, PMI basically should be less than 50, and yuan should be greater than 7.5. The manufacturing PMI for there is basically moving to contraction. Credit growth is also less than 8%. So there are breaches in this. The only thing holding right now for us is basically yuan is still not devalued against the dollar, and it looks difficult at this stage of time. We don't think dollar strength continues. The recent strength in dollar that we saw almost over the last month or so, last week, the dollar has lost a lot of strength, but prior to that, dollar was strong, and we think that that strength does not have the legs to kind of run for a long period of time. So if the dollar were to weaken, we don't think that yuan could now trip over or devalue against the dollar. So that is holding, and hence we say that that is the reason that for us the overweight kind of makes sense. If the stimulus hasn't come, if there is not enough money, if yuan isn't out there, yet it is appreciating against the dollar, that means the currency is really strong, and in that strong currency, the economy should kind of bounce back pretty fast. So that is why we continue to remain overweight on China. In terms of India valuation again partially fired for us. Why? Because we started the year at 24x. We're now at almost 20.5x. We've stayed overweight over the period of time in sectors that were made for inflation. What that has done is basically the reason why this has happened is that we thought that probably Nifty PE would stay above 24 for a long period of time, which did not happen. What triggered the valuation compression was basically outflows, where we'd set a bar that greater than $3 billion per month is where we'd set a bar. Till that time, the average outflow would be around $1.5 billion per month. So we thought $3 billion per month was a pretty decent target to keep. However, we saw what happened in the first half of the year. $30 billion have gotten away from the country, and hence we see that the compression itself has taken place. So the valuation has gone down from 24 to 20.5x now. In an expensive world, in a world riddled with inflation, if you're getting something for cheap, obviously the reason is there. The reason is that India is being treated as an anti-AI thesis, but an anti-AI trade. However, a fast-growing economy, like the fastest growing in the world, available for a cheap valuation in an inflationary world, becomes a much easier trade or a very less risky trade for anyone. So we see that probably FIIs start come back into India in certain times as well. Once they've seen the volatility in Korean markets, once they've seen that volatility in the US markets, events like situationally aware blow-ups happen, and this is probably not the first one, or this is not probably not the only one. There will be other cases as well. There's a lot of leverage out there. So once that happens, to protect itself, you would want a place which is kind of less risky in that manner, and we feel that India is one of them, and hence we continue with our overweight there. Earnings cut again have deepened, so again partially fired for us. Why? Because the results itself, if you look at the last quarter results as well, 80% of the firms grew sales year on year. The quarter on quarter profit breadth was also up 68% despite the conflict itself. So all of that, while the conflict, we thought that at the beginning of the year analysts had cut ratings, it did not take place. The final results are pretty decent as well. So earnings cut deepen is also partially fired for us. Something that's not fired, obviously, oil is not above $115, but here is a place where briefly so basically what we've done is this is the first month crude oil minus second month crude oil. So this is your spread between the first and the second month. as I said that your second month should higher valued than your first month. So you should have a number less than zero, while we have a number greater than zero right now. For a brief period of time there, it did go into contango, but has moved back into backwardation. Now you would observe here that generally in a period where everything is very fine, the market kind of tries to go stay in contango, which is how it should be. It should, you have your storage cost and you have your insurance cost and you have your financing cost as well. So basically three reasons why you should have a contango out there. But whenever a conflict comes in, you have this brief period where your first month or your spot prices go up much. However, that every time that this has happened since March this time around, uh, the market has said that we don't believe that the conflict kind of stays on for a long period of time. So every time that has happened, we are moving back into backwardation. If this were to slip back into contango and the conflict was on, then your $100 extended period of oil becomes a reality and eventually fuels the inflation trade that is going on as well. In terms of global recessions, we don't think again GDP everywhere is holding up. The only thing that is not holding up is the inflation table. This is on. These are much higher numbers than where we started out the year from, and we think that this should continue. So this is something that one should kind of look at. The rupee kind of breaches 100. Now this is interesting. Why? Because we thought that this can happen because of a few reasons. Your RBI reserves should go below $650 is what we've kind of kept. What the FPI outflows for RBI reserves to defend the rupee. What we saw was, again, every time that you've been on this and we've been asked this rupee question, what we have said that over time, had you let rupee play out the way it would have over the last 6 years time, we would still have reached $95, $96. The reason why this particular fall or this devaluation looks kind of very steep and very hurtful is because for a brief period of time between 2021 to 2024, we kept rupee in a very tight range of $78 to $81. That $78 to $81, it just go back to September 2024, the time that a lot of retail was buying into equity. That the major reason to buy in, or the news at that particular point of time, was that rupee is one of the strongest currencies in emerging market. We were at $81 and we were at between $78 to $81 for almost a 3-year period. And post that, we had a change in RBI, where they said that we will no more defend the rupee. We will let market forces decide that the rupee should kind of find its value on its own. So when market forces come in, based on generally the depreciation, what we've seen over years is generally around 3.5% to 4%. This 3.5% to 4% is because the rates in US and rates in India, the difference is around that much. It's not. This is a very back of the envelope calculation. It's not that simple. That when you push in inflation, it becomes slightly a complex formula. But if you want to just do a back of the envelope calculation, the difference between the interest rates itself tell you how much the rupee should kind of depreciate. The rupee should depreciate around 3.5% to 4%. If you look at the last since COVID times, the difference between US yields and Indian yields have been around 2.5% to 3%. So let's say if rupee were to devalue by 3% over the last 6 years, or depreciate over the last 6 years by 3%, then the day that COVID happened, we were at almost $77. From there to here, we should be around $95, and that is where we are. So we don't think that this is a runaway move or something like that. We believe that this is something that the market forces have kind of continued to do. Now, what happens going forward? If you let markets be, right, then markets will devalue rupee as the differential of the yields, right? And if you followed us, another thing that we're least uncertain about, that in an inflationary world, the yields in US keep on going up, especially when you have almost $30 trillion of debt, $40 trillion of debt. Again, just a number there, 40 trillion, 45 trillion. Beyond a small number, it just becomes a number. So I think they have around $40 trillion of debt. If that is there, and in an inflationary world, yields in US start going up pretty rapidly. If that happens, yields in India will also go up, but probably not at the same pace. If the pace is the same, then it should continue to devalue at around 3%. If the pace is not the same, then what happens is that the difference between your US and your Indian yield curve starts coming down. And if that's the case, there could be a possibility that the rupee could actually appreciate versus the dollar. Looks like something that is not possible at this point of time, but you'll be surprised when things happen. Again, when in September 2024 we publicly said to move to cash. Everyone wanted to be in small caps. We said that it become pretty frothy. So again, if the yields in US start to take up, which they are almost around right now, if you look at it, it would be around 4.7 odd %, and it's kind of starting to grow very fast. So if the yield in US take off, there is a possibility that Indian rupee could start actually appreciating versus the US dollar. So we don't think that the rupee breaches 100 very soon. So that for us is at least not fired out there. One more thing that we also kept a RBI reserve of less than $650 billion. The reserves have fallen from $730 billion, but they are still above the $650 billion that we kind of kept as a tripwire. So for that reason as well, the rupee has not breached $100 for us, or that risk has not triggered for us. The US labor market at this point of time, at the beginning of the year, when we were looking at non-farm payrolls in the US and the unemployment rate, it was kind of moving up. So the unemployment rate was moving up and non-farm payrolls was coming down. What is non-farm payrolls? The number of people, the number of jobs beyond agriculture is the non-farm payrolls. A higher number there is actually a better number. A lower number in your unemployment rate is a better number. Job openings, obviously a higher number is better, and average hourly earnings, a higher number is better. So when we were moving into this year, the unemployment rate was actually going up. The non-farm payrolls was coming down. Job openings was kind of very sticky, but it was still on a downtrend. And the hourly earnings was again very sticky, but almost flat kind of thing. So that gave us enough reasons to add this as a risk that probably if it were to continue, unemployment rates in US would start going up. For that, we were tracking, and we still track something which is called the SAM rules. The SAM rule is basically that if the SAM number, if you just go and search for SAM rule, you'll get a particular number, should be in point numbers, so decimal numbers. If that number becomes more than 0.5, then you have trouble. So that's an early indication of recession out there. For us, the labor market crack would have happened had the unemployment been greater than 5%, if the job openings had dropped below 7 million, and the wage growth had gone below 3%. We've seen that none of that has happened. Although the cooling is real, if you look at the very recent numbers, what have happened, published, they were very large. So what they're doing is they're revising down their numbers and continuously revising it down the numbers. When we meet again, let's say in a month, 2 months, 3 months time, these numbers would look much lower, like much different and on a lower trajectory. And especially this particular number, the number 57 that has come out this month, has been much lower than expectation. I think the consensus was around 115,000. So the number should have been 115. It's come out to be 57. So for us, that this has also kind of this is also a risk that one should kind of keep looking at because it's starting to it may start to materialize as well. There are a few new entrants to risk. Obviously, this risk dashboard we have to take in account, because whatever has gotten us here, we need to keep updating as well. Now that the base case has become now that risk of second inflation wave has become the base case, and we made portfolios around that no more remains a risk for us. So that's been promoted out. But the opposite end of it now becomes a risk for us. So basically, in a world which becomes disinflationary, that becomes a risk for us, because our portfolios are kind of moving towards protecting against higher inflation numbers. So if inflation numbers will start come down very fast, then that becomes kind of a risk for us. So we've again started adding early warning signals, and what do we do and when that happens. The second one is that we found out that when inflation starts turning and central banks respond, right, there is this weird 9 to 15 months gap that happens. Why does that happen? And you could see that uh, in the Fed meeting as well, in other central bank meeting as well. Central banks are kind of not very sure whether they want to hike rates or not. And when they're not sure, this gives you this particular 9 to 15 month window for equity where inflation rates go up, inflation goes up, a rising inflation without a rising interest rates is generally good for equity because the margins can start like those who can pass on prices to consumers, their margins start doing really well. So this small equity window kind of gets like which has opened up for us. If there is a rate hike in the second half in the back end of the year, then that window kind of shrinks for us. So that's another risk that we kind of look at. And the third one is obviously everyone's head right now is the AI Capex digestion. What this means is that whatever has been built till now, it just stops, right? So where are we on AI? We are in AI, we are in this building phase. So we are rapidly increasing our capacities at uh, at the expense of not having cash flows. But let's say tomorrow those capacity expansions were to stop, and they say that whatever we've built till now, let's start using it. So basically, that's your capex digestion. What you've done is you've done capex, but now you want to digest the capex. If that happens, then you have to move to different places in your allocation in your portfolio. So the memory or those ones which are kind of building you or being used in your capex, those do not become the theme. Instead, those using those capex become the primary holders of your portfolio. Those are the ones that you should kind of invest into because those are the ones that will gain out in this entire phase. So now this is our risk dashboard. We've taken out inflation second wave, low intensity long conflict also kind of fired, so that goes out. Compression. So for valuation compression, because the results are decent enough, we've reducing the probability that it happens this year. So from 25% it's come down to 20%. Earnings cut as well. Earnings cut the probabilities come out. Valuations we've already seen from 24 to 20x valuation. So for that, again, we have more. We're not at a high valuation zone. So compression there also cannot take place. So that also gets reduced. China stimulus disappoints. Again, something very predictable, already disappointed. So the probability of it disappointing more goes down. Any small stimulus from now also will be cheered from the market. So that also reduces in probability. What increases in probability are two things, and one almost there. One is oil above $115 extended. Why this happens? Because you now basically finding a base. So before the conflict started, you were finding a base between $60 to $70. Go back to February, when the conflict kind of 28th February, you were at $60-$70 a barrel for oil. Now you're moving to that 80-90 range. Any flare up now can easily put your oil back to your $115 to $150 range as well. So that probability kind of goes up. Another one also goes up because if oil were to go up to $115, the recession probabilities also will kind of go up. Along with that, another one that we debated a lot on was basically a labor market, the US labor market crack. There we're not seeing numbers come down, and hence we've not increased that probability. But if once the numbers, we already started with the non-farm payroll being 75K versus 115K, 57K versus 115K. So if that continues, if that trend continues, this particular probability also starts going up, and all three of them kind of are not mutually exclusive. They can happen all together as well. So all of those become trades as well. We already, again, what will fire these and what we'll do basically again is noted down. Any given day this happens, we move our portfolios that way. So there is no panic reaction as such. You prepared for something that you think could come in. Another thing that is there, which is called the Knight's line. This is something which is an uncertainty. It is not a risk. And there are certain which are there. You already seen AI go rogue across the world, uh, almost 2-3 times in the last 2-3 weeks. For that, this becomes a big. Again, you can't put a number to this, how good, how bad it will be, but you already may have received a cyber security report from us already back in March itself. We prepared for this kind of risk. So again, whichever risk here, we can't put a number to it. We can't put a probability number to it. These are something that is an uncertainty. But you can always prepare for it. So how you can prepare against cyber and data theft is basically have cyber security companies invest into them. They will probably help save, stop AIs go rogue. Energy and grid failure as well. So this is one that again you saw us invest into oil drillers at the beginning of the year, because we thought that if there is an issue with energy, then this is what happens. Election surprises, unfortunately, we can't prepare for them, but there is a midterm elections coming later this year. At this stage, we don't have a hedge against this right now, but we'll probably build an hedge. The easiest hedge that we can think of at the top of our head is basically have your real assets like your gold and silver into it, and that we already have started started investing into for client portfolios. If you've got a portfolio with us, you're already in there, beginning to get in there. So that's there. The position now, what we've done is that we've seen that US has gone through kind of a correction. So that is giving us decent opportunity to get in. So we're increasing the US weight. On the contrary, Indian small caps we feel has gone through. So this is a very short-term tactical point. We are rotating across sectors as well. So you would see us come out in cash. We're generally coming out in cash in the small cap universe. That for us as kind of if you actually look at the divergence that is happening between Nifty and Nifty small cap. Nifty is pretty much, I think, if you look at it, Nifty high is around 26,000 odd. Currently, it is around 24,000, so it's almost 10% lower than its all-time high. While Nifty small cap index itself is pretty much at its highest point as well. So this particular divergence gives us that valuation benefit that if there is a correction that may occur, then probably large cap is the place to hide into, and that's what we kind of doing. Valuations also in small caps are right now around 36x the median. Versus the 30x 7-year median. What we actually held was basically metals, energy. We've raised cash tactically. You've seen us rotate into quality as well. We added pharma wherever it was required, gained out of it, and then again whenever we want to avoid risk, we're adding pharma, which is the best way we've found to reduce risk in portfolios. And gold and silver, again, as we said, that we kept on adding on to yes, these are the results till now. The results till now, again, are pretty decent. Just how we measure results is basically we see at numbers like just the same quarter last year, how many companies gave better returns this particular quarter itself when compared to last year. Pretty decent results across the board. Both in sales and profit. So again, when we look at both of them and combine this number around 80, 75, and 69, and a total of 74%, this is one like very decent number that we've seen whenever we have tracked these numbers. In terms of quarter-on-quarter sales, this is something where issues happen because there are a number of companies that are cyclical in nature. So again, that becomes a problem. And I think the sectors that are really doing well is banks and gems and jewelries, the results that have come out till now, and aerospace and defense and cements are kind of the places where results are not that great. When you look at how we kind of manage portfolios, we like to take out. So if you look at bank results as well, bank results in the last quarter were also very decent. Bank results this quarter are also very decent. So selling into a very when the market is very choppy, given again not a thumb rule for us, it depends on where you are in the market cycle. When the markets are very choppy, selling into decent results has proved beneficial for us, and buying in a cyclical downturn as well in sectors have become very lucrative for us. So again, things like shipbuilding, things like defense, although their results are not that great, we think that those are a decent place to buy in a world that is inflationary, really driven by a fragmented world, which leads to sector allocation in that manner. Uh, Again, we don't lead with performance. We've not done that anytime. We lead with the risk. However, the performance again has been decent. The last 2 months, again, this is particularly the first phase of a bull run. If you look at the first phase of a bull run, what happens is that the companies which are very low valued, even though not very good quality, they kind of start moving up very fast. Those are the ones where really attracting money because there is not much to lose. We've not left our quality bias. So again, we expect the difference between the benchmark and our portfolios kind of to again start becoming much higher. It's starting to narrow a bit for us. Not very happy with it, but going into the second half of the bull run, we think this should kind of extend out. Given that where we are in August map, what we feel here, uh, not much different than your July map. There is absolutely nothing to tell you. It's a choppy market. There is no denying it. So two things that I'll kind of look at, two numbers that I'll probably look at. One, and that gives me any indication as to where the market wants to really move, because this has almost become since the end of I think, I don't know, since April, we've been in this very chop range. What I would do is that close for a week along a sustained close about 24,500 could eventually tell me that we've cleared all of this mess here, or we look for a sustained close below 23,200. If that happens, then then issues start coming up. However, realize that even then you are flanked by two very large demand zones. So again, looking at 26,360 above this or 21,750, either a real big squeeze happens, which is where a lot of people have shorted the market, then they get squeezed out and this moves very fast. Generally, it should not be the ideally be the case because there is a lot of supply on the top. Similarly, there is a lot of demand at the bottom. So every time that what we've figured out here is that um, and when you hit a supply zone, take out your low conviction stocks. Whenever you hit a demand zone, add on to your high conviction stocks and keep that rotation in place till the time that the market clears out what it really wants to do. But however, whichever way we go, I think 25,000 number or 23,200 number are the two numbers that really should define as to where we should go. Even if we close above 25,000, it will take time to take out this particular supply zone. Even if we close below 23,200, it would take time to take out this particular demand zone, both sides. It will take time, but it will at least tell you the direction into which we are kind of moving. With that, what we have done is that in this indecision zone, we move to again 10 to 25% cash. Probably once it comes back to our demand zone, we'll kind of rotate into the sectors that the stocks that we kind of or the places that we think are the ones that run for a longer period of time. And yeah, that's pretty much it. Whenever what has worked here is that whenever we've tried to reduce risk, we've reduced risk through adding defensives. So maybe consumer defensives, a few good companies out there kind of looking good in staples and in terms of in pharma as well. So that's how we've kind of reduced risk. And whenever we wanted to add risk, you add risk through to sectors which should do really well when inflation kind of picks up. So basically, sectors like energy, oil drillers, power-based metals. Metals is something that we kind of have kept overweight, and energy is something that we've kept on overweighting. Uh, Rotating into quality in the second half of a bull run is ideally a good place to be. And yeah, add pharma, gold, and silver when you want to kind of add defensiveness to the portfolio. So that's how kind of we've positioned ourselves. Um Having said all of that, if you really don't know how your portfolio is positioned, we made this tool where if you just log on to myapp.lamaresearch.in/analyzer, then you can we score your portfolio based on where you where we are in the market cycle. So, and based on all the rest that we've kind of done, the model takes it up and tells you how good a portfolio it is. It also tells you how you can improve the portfolio as well. So go ahead, try the tool out. Happy to take on questions as well for the session. So that's a good, interesting question. We've got a question which says that US bond yields are shooting up. Fed is not increasing interest rates and won't kind of won't stop the conflict. So shouldn't Trump chicken out? Okay. Trump, if you go back to your tariff day, and if you actually go back to tariff day, and you look at where Trump chickened out, we are very close to those levels. So I think Trump chickened out at 4.7% there. We were pretty close to that. Do we have 10-year here? I think a weekly chart would be decent. Okay. So I think this is where tariff came in. So I think 2nd of April 2025 is where the tariff came in. And right before that, I think this is the high. This is where Trump kind of chickens out, and you've seen that once happened during tariff. This is 2nd April is when he introduced the tariff. Let me actually move this to a daily chart. That would be much easier. So, okay. So this is 2nd of April. This is your Liberation Day. This is your tariff day. Then very next day you had yield started to spike up till almost 4.6 odd percent, and this is where they announced a extension. I think the first thing was extension. First thing was that on 2nd of April he'd given 30 days. On 9th of April he'd given 90 days. So this is that 90-day announcement which came across. So he kind of chickened out here. Once that 90 days happened, he extended it forward again, chickening out at around 4.6%. And again, during the conflict as well, this is where I think he announced the ceasefire as well. So again, 4.6 odd is the region where he kind of where he gets cold feet. I think we are above that region, so we are moving above that, and he's still not finding a solution. I think the next place that he kind of starts getting cold feet is somewhere around this. So he mentally he has been able to reach to a fact that he's gonna see 4.6 for some bit of time. Yeah, so I think the next time that kind of he gets into trouble is somewhere around here. That's where you kind of see probably another ceasefire or something like that. So yeah, still I think there's still room to run. In a world that is fragmented or moving more towards fragmentation, I think one thing that we're kind of getting sure about is that yields in US kind of stay higher. Whatever that be the case, I think yields in US should kind of move towards 5 odd percent. Will that give inflation a problem? I don't think so. It's more in terms of the issues that we are seeing in the US right now with a high debt and ballooning kind of defense spend. I think yields should go up. So that's there. How to find undervalued stock and the risk to keep in mind. Okay, Anirudh, this is an interesting question. How to find an undervalued stock? We've kind of done this exercise before as well, and I'll drive you towards our YouTube channel as well, where we've taken this particular question in Money Nest sessions. So we've told you how to find out stocks which are undervalued and decent quality as well. You can actually take a look, and I would really drive you towards the YouTube section of and the Money Nest section of our thing. However, figuring out undervalued stocks, either you can do it through fundamentals, which is the easier way of doing it. So you look at certain ratios which are basically your price to earnings or price to sales or price to book. These are your ratios that tell you how expensive a stock is versus its underlying fundamental. However, a major reason is that everyone knows this. So you would the issue with this is that at times these are false matrices. So what does it mean in terms of false matrices? Is that it is undervalued for a reason. So you'll have to figure out why the stock is kind of trading at the PE at it is trading. If it was available, let's say at a 5, generally a stock which is available less than 20 times your earnings or 22 times your earnings, those are the ones, or 15 times earnings. Again, there's a particular number which is called gram number that you can go for. This is, I think, if you're talking about valuations, one person that you should really read about is Benjamin Graham, who talks about valuation. In his book Intelligent Investor, he's given you a formula which is basically price by book into price by earning should be less than 22.5, which means that your price to earning should be less than 15, and price to book should be less than 1.5. So these are the two numbers that you actually look at and try to look at them less than 22.5. The problem with this is that everyone knows about it. The problem with this is that in an expensive world, this is very difficult to find. And if you do find one, then you have to understand the reason why actually they are valued the way they are. That it means that the market probably knows something that is why it's kind of undervaluing it in a way. So if you're looking for undervalued companies, difficult to find. The best place that we found companies, or the ones that we think should give you decent returns going forward, are the ones that are priced decently but are growing very fast, or in sectors which are very growing very fast. So that kind of don't go for that pure number of PE less than 15. A company which is at PE of 40 as well is also undervalued if the growth and the future growth can sustain it, and the market kind of gives it that kind of valuation, then it could be undervalued as well. You don't know, anything that is valued at 40 today can be valued at 80 next year as well. So you really don't know. Uh, Again, just one parameter like a PE, PB, PS, something like that, that we don't want to give you and leave you hanging there, because that can lead to a lot of false errors in the whole segment. So yeah, that's there. Any other question? That okay? There's another question. Okay, so it's basically P by E. So that's your PE ratio, and then you multiply this. So you multiply this, and you do your P by B, and then that should be less than 22.5. So I think that's your equation there. So this is called the gram number. So we just got another chat. We said, I read a book of Parag Parekh. He said the best thing is to buy index fund. What index would you recommend apart from India and US? Well, index funds are a very decent and the cheapest way to kind of get exposure to a particular country. Why? Except that we think that those are really decent products to look at. However, if you understand, if you're investing to generate alpha, then index funds won't give you alpha because they'll be tracking the index itself. So if your major goal is basically to get market returns, then having like there is no alternative to index funds. We believe those are very low cost products to get exposure to market returns. If you want to beat the market, then you should kind of look at active funds, is what we believe. In terms of countries, I think you were asking India, USA. I think China looks really good at this point of time. So if you've got ETFs in China, the one that are there on our, again, not a recommendation as such, but the one that we've got here in India is Hang Seng Bees. You can take a look at that. There are other ETFs as well, particularly sector ones as well. So you can take a look there. After the correction, I think Korea also looks decent, but remember that being at a low and being at a high, and the journey to the high can take time. We've seen that in Indian markets. While we are very close, we're not at the bottom. When we were at the bottom, we said we are at the bottom. Those are very good places to add exposure to it, but we're still not at the high. So the journey from the low to the high can take time. And given that the run up in Korea was pretty fast and built on a lot of leverage, I think it would probably take time for Korea to kind of go ahead and beat that particular high. It can do that tomorrow. It can I can be proven wrong as well. But general idea is that it should generally it should consolidate around these areas. However, after the correction, the risk in Korea is kind of quite low. It can take time to give you returns, but the risk there is quite low, is what we feel. However, given all the fundamentals and given all the places that we've looked at, I think China looks a decent place to add on to apart from India and US. So yeah, if there is no other question, I think this was a fruitful session because we talked a lot about risk. Not many people talk about risk. It's not attractive. It's probably one of the most boring things to talk about, and especially on a Saturday morning. So thank you for having the patience to stay on, looking at it. And the idea here is that keep your risk in check, because that will eventually, if you avoid the pitfalls, then it's much easier to kind of go ahead and make returns as well. So these are the particular risks that we're looking at. Happy to take on any other conversation or any other risk that you have in mind. If you do want to reach out, we are available and happy to talk on that as well. With that, I think have a good weekend ahead and a good month ahead. Thank you guys. Thank you for attending this session.